Good afternoon, South Carolina Realtors. Happy to have y'all here with us today. We have an exciting presentation from Dr. Joey von Nessen. He is a premier economist at the University of South Carolina. His full bio has been included in the registration, so please go back and look at that if you would wish. But we've contracted with him multiple engagements, and we're happy to say that we have a partnership for this half of the year and the second half of the year, with another presentation coming up in 2025. But we do know so much about him, but we wanted some interesting facts as well. So the interesting fact is that he was a DJ at B106.7 here in Columbia during his graduate school at USC. So while he was earning his PhD. But I wanted to say thank you so much for coming out here today, and want to remind all of our viewers that today the recording is going to be on our YouTube channel. Please subscribe to South Carolina Realtors and look forward to seeing that live. Thank you. Joey, please take the mic.
Sounds great. Well, thank you, Alan, and appreciate that kind introduction. And it's good to see everybody this afternoon. I'm going to take just a moment and share my screen. And Alan, if you wouldn't mind just giving me a confirmation that you can see everything there, and I think
Yes,
we'll
sir,
be good to go.
See you.
Perfect. Sounds great. Well, it's great to be here, and it's great to be with everyone this afternoon. Thank you again for inviting me to be with you. Again, my name is Joey von Nessen. I am a research economist at the Darla School of Business, where, as many of you know, we practice applied economic research, or what I always like to call so what economics, meaning we're always looking at economic data and asking the question, so what? How can we use economic data to help businesses and organizations make good strategic decisions? So in that spirit, this afternoon, we're going to be talking about the South Carolina economic outlook for the rest of 2024. We'll first look back a bit to assess how we got to where we are today in mid-July. Talk about what the state of the economy is right now, and then our expectations as we move forward for the rest of 2024 and even into 2025. We'll talk a little bit about the longer term outlook as well, both overall and of course specifically for housing markets. So as we get started then, I think a good way to frame the discussion surrounding where the economy is just to ask the simple question of how are we doing? And one way we can do that is to offer the economy a grade. One way to think about it and frame our discussion, and then we'll talk about why this is the grade that we're currently giving the South Carolina and the U.S. economy. And that grade is a B+. That's where we're rating the economy as it stands today in mid-July of 2024. And a B+ means that there are many metrics that show that the economy has been very resilient. It continues to grow. It continues to do fairly well overall. We've seen that through steady rates of consumer spending and overall GDP growth. We see that through a very strong labor market, unemployment still historically at historically low rates. And we've also seen very sizable wage gains over the past year that have extended into 2024. So we are continuing to see a very resilient economy that's continuing to expand. But at the same time, consumers, as we all know, have lost significant purchasing power over the last several years and are still facing the consequences and seeing the consequences of high inflation that occurred in 2021 and especially in 2022. So although the economy overall continues to grow, continues to do well, it certainly can't get an A right now, given the loss in purchasing power that most consumers have seen and are still facing the consequences of. So that's where we stand today. So let's talk a bit more in detail about how we got here and what our expectations are going forward. And the other way to do this, when we think about the economy overall and the current economic paradigm that we find ourselves in, even though the economy we'd rate right now is about a B+ in terms of overall performance, if we look at the economic paradigm and how it's changed since the pandemic began in 2020, one way to look at this paradigm shift is by considering this current move or moment that we're in as a period of the Great Readjustment. Just like we saw the Great Recession in 2008, we saw the Great Expansion in the previous decade, in the 2010s, between 2010 and 2020, a 10-year period of economic growth. Now we're in a period of readjustment, what we might call the Great Readjustment. which started following the pandemic recession in 2020. And what that readjustment means is that beginning with the pandemic, we moved into a period where demand has been far outpacing supply. And that was especially true in 2021 and in 2022. That led to increases in prices, and increases in prices at the national level is what we all know as inflation. So very much an imbalanced economy in terms of an imbalance between supply and demand emerged in 2020 and 2021. It generated higher prices and higher inflation. And now we are readjusting from that imbalance or from that disequilibrium back to more of a balance, more of an equilibrium between supply and demand. But that readjustment period is a multi-year, it's a multi-year readjustment, and we are still in that process of moving back to an equilibrium. So the Great Readjustment was happening in 2023, and it's continuing to happen in 2024. So a lot of what we talk about this afternoon, we need to think about in the broader framework of this Great Readjustment that the US and South Carolina economies are going through as we navigate back to more of a steady state or an equilibrium between supply and demand. Now, why did we see this disequilibrium emerge? Well, there were two primary reasons that we saw a surge in demand in 2020 and in 2021 and in 2022 as well. And one reason was we saw a rapid labor market recovery following the COVID recession in 2020. And here we can see that very clearly in South Carolina. We can look at overall employment trends. You can see the rapid loss in employment that occurred in between February and April of 2020, where we lost about 15% of our total job base in South Carolina. And that was then followed by a rapid recovery. People went back to work as the economy reopened. And we've actually seen very stable and steady rates of employment growth overall ever since. So this is not just a story of the fact that we saw a movement to get all the jobs that were lost back in a fairly short period of time, although that was certainly true. You can see here where we crossed that line from before the pandemic. But we've seen steady rates of job growth ever since. And in fact, job growth on average over the last several years has been higher by more than a percentage point. It's been higher than it was between 2010 and 2019. As you can see, about 3.5% annual growth compared to 2.1% between 2010 and 2019. And so from the perspective of demand, as people go back to work, they're earning incomes and then they're spending that income in the local economy. So that's part of the story. The other part of the story is that we saw $6 trillion in stimulus in 2020 and in 2021. And that made its way directly to consumers, to American households in many cases. And that took the form of the stimulus checks that most of us are aware of, a variety of tax credits that many had access to, extended unemployment insurance benefits. So there were a variety of ways that $6 trillion in stimulus was directly accessible by consumers, by American households. And so they were able to go and spend those dollars as well. And it put consumers in a very good financial position. And we are still seeing that in mid-2024, which you can see illustrated here. So this is personal disposable income levels in the United States, inflation adjusted. So these are what we call real dollars, real just meaning inflation adjusted. And you can see on average today, disposable income levels are actually higher than they were for American households compared to where we were before the pandemic. A lot of that has to do with wage growth. A lot of that has to do with access to those stimulus dollars. And a lot of that has to do with a thriving stock market where financial assets and real estate assets have been doing extraordinarily well from the purpose of, or from the perspective of generating more wealth for households and for consumers. And so that translates here into higher disposable income levels, which has also helped to keep consumer spending elevated. So you put these two factors together, $6 trillion in stimulus and a rapid labor market recovery. And that's why we saw this rapid recovery and very stable consumer spending that has basically persisted ever since. So here we can look at total consumer spending for the US economy as a whole. Again, a rapid rebound in 2020 into 2021, and very stable rates of growth ever since in terms of overall consumer spending. Now, that's the story at a 30,000-foot view. So we have seen very stable rates of consumer spending because of these factors that have been driving demand. And consumer spending represents about 70% of GDP, about 70% of the total economy. But the problem is that consumer spending is not distributed equally across industries. So even though consumer spending has been fairly stable overall, again, at a 30,000-foot view, if we dig a little bit deeper, we can see that that's not necessarily the case at the individual industry level. And especially if we just compare the goods market to the services market. And you can see that very clearly here, where in 2020 and in 2021, because we were all socially distanced, when consumers and households had access to all of these financial reserves and additional financial resources, they were spending those dollars mostly in the goods market. They weren't going out to eat. They weren't traveling. They certainly weren't getting on an airplane. And so all of those dollars were being spent in the goods sector instead of the services sector, which generated a goods bubble, and especially a durable goods bubble that we are still readjusting from. Remember, we talk about that great readjustment that the US and South Carolina economy are both going through. And part of that great readjustment is an adjustment away from, or a deflation of, this durable goods bubble that peaked in 2021, as you can see on the left-hand side of your screen. And from the perspective of South Carolina, that had practical consequences both for the housing market and for manufacturing. And of course, both of those are within the goods market. And so as we all know, the housing market has seen a similar shape that the goods market has overall, namely a mini housing bubble in effect is what we've seen over the last several years, just as more broadly, we've seen a goods bubble, which is now deflating following a surge in 2020 and in 2021. So overall, we've seen a resilient economy that has continued to perform well, but is also readjusting, also going through that great readjustment, and certain sectors are having to readjust more than others. So that's the good news overall in terms of where we are. A resilient economy, steady consumer spending that has persisted through mid-2024. Household financial resources still very stable. As we looked at before, disposable income levels actually are still higher than they were in 2019 and 2020 before the pandemic began, even when we adjust there for inflation. And we also see a healthy labor market. Job gains have been very steady in South Carolina and at the US level, and unemployment still close to historic lows, which is good news, especially for housing, because the single best predictor for housing demand is the strength of the labor market. So critically important that we continue to see a healthy labor market as we move forward. Now, let's talk a bit more about the bad news. It's not all good news, of course. Again, getting back to that B+ rating, we've seen resiliency, but this loss of purchasing power and the effects that it's had on the consumer and the effects on businesses have both been significant. Both inflation and rising interest rates have taken their toll. And we can see that from a consumer perspective and from a business perspective. And we can go through a couple of ways to illustrate this point. But this, I think, is the easiest way to really see the reason for, or the implications of high inflation and what its effect has really been on the US and South Carolina economies. And that's just by directly comparing total inflation to total wage growth. Just a straight comparison of what we've seen over the last several years. So this particular graph, as you can see, compares inflation and wage growth over the past 3 years, from 2021 to 2024. And you'll note here in the bottom two, hopefully you can see my mouse here, but average hourly earnings up about 14.6% over the last 3 years. Again, overall, on average. And inflation, total inflation is up about 15.7% over this 3-year period. So that shows you right there the loss in purchasing power that we've seen as Americans, because inflation has risen by about a percentage point faster than earnings over the past 3 years as a whole. Now, I say that, and you might look at those data and you'd say, okay, well, that might be true, but it really feels like I've lost a lot more purchasing power than just 1 percentage point here. This difference doesn't seem to be very, very significant. And that's because there are two other things going on here that are important to recognize. Number one is that if we look at food and energy prices, which you see in the top 2 bars here, they've gone up by a lot more than overall inflation. And food and energy prices are what we tend to see as consumers most often. So anytime we're encountering prices, usually it's at the grocery store and at the gas pump. That's where most consumers see price changes on the most frequent basis, or encounter market prices on the most frequent basis. And so here, a much bigger difference, right, between average hourly earnings and what we're seeing in terms of inflation for food and energy prices. So part of it is what we're exposed to, what we see, what we're buying on a regular basis. That makes a big difference. But the other factor, which is also very important, is to zoom in a little bit more and look at the difference between wage growth and inflation just in the last 12 months, which is what we see here. And here we get a very different story. Here we see that wage growth has actually outpaced inflation by almost a full percentage point. Wages have grown about 3.9% over the last year between 2023 and 2024. Inflation has gone up by 3%. So about a close to a 1 percentage point difference overall. Now, why is that so important? Because what this says is that inflation has fallen below wage growth. And so now consumers are beginning to claw back some of that lost purchasing power. And in fact, a pretty big difference there, 3.9% versus 3.0%. But what it also says is that even though wages have been rising faster than prices for over the last year, that has not been enough to undo this loss in purchasing power, because this difference here of about 1 percentage point takes into account the fact that inflation or earnings have outpaced inflation for over the last year, 3.9 versus 3.0%. So what that tells us is that inflation in 2021 and 2022 was extremely significant in terms of generating a loss in purchasing power, because even though we've been clawing back purchasing power in the last year, it's not enough to offset the overall losses or the overall picture that we've seen in the last 3 years. So we're moving in the right direction. We're seeing improvement here, but still in the aggregate over the last 3 years, purchasing power is still down, and it was significantly down, especially in 2021 and in 2022. And so it's those types of losses that consumers are feeling that explain a lot of what's going on here. If we look at consumer sentiment, you can see it is still way down compared to pre-pandemic norms. So even though we have inflation that's at 3% that has been coming down, even though we have a very resilient economy, that just hasn't translated into improvements in consumer sentiment. Maybe somewhat, but we're still a long way from where we were before the pandemic began. And I think a lot of that, if not the majority of that lack of consumer sentiment or low consumer sentiment, is the result of this loss in purchasing power. It has had a lot of long-term consequences that have lingered. Again, as you can see, even though we've had a year where we've actually been building back up or clawing back some of that lost purchasing power, we're still down on the whole when we look over the last 3 years. Now, we can also look from an industry perspective. That's from a consumer perspective. But if we look at at what's been going on with interest rates, we've seen significant effects as well. And that's particularly true for housing and manufacturing across the US and especially in South Carolina, where we've seen a significant pullback in the last 2 years since interest rates started rising back in March of 2022. And why is that the case? Why has housing and manufacturing both seen a significant pullback? And why has housing seen such a significant, had such a significant effect that's been above and beyond really any other industry, including manufacturing? And the reason is very simple. When interest rates rise, housing markets are typically hit first and they're typically hit hardest. And that's because housing is the most expensive item that most consumers buy. And so that has a significant impact on affordability when interest rates rise. So it's not unusual at all for housing to really bear the brunt of that impact when interest rates rise. And that's what we've seen over the last 2 years. And in many respects, this is something that I talk about a lot, that housing has really been on the front lines in this ongoing battle against inflation. There's no way around that. We have no way around that conclusion. I mean, we've very clearly seen that. Interest rates started going up in 2022 as a direct effort to try and pull down inflation, and housing has seen a major pullback as a result of that. Now, the good news is that the bulk of this readjustment, as you see here, is likely behind us. So again, we're all aware of the pullback in demand that the housing market has seen over the last several years, but we've seen significant stabilization in 2024, which is very good news as we move forward into the second half of the year. So I'll just briefly go through some data to illustrate this. Here we can look at South Carolina housing sales. These are annual growth rates going back to 2017. And you can just get a picture of what's been happening over the last several years. And in general, this picture should remind you of that durable goods bubble that we looked at before, that durable goods bubble that we saw when examining consumer spending. We see a significant increase in growth and demand in 2020 and in 2021, where it peaks. Then we see a pullback, but we don't see any negative growth rates. Again, anything below zero, below this black horizontal line here, until the Fed begins to increase interest rates in March of 2022. And then we see a very real contraction in sales activity, negative growth rates. That then drops down, bottoms out, and we've seen stabilization or the beginnings of stabilization in 2023, but really in 2024, growth rates have actually almost fully recovered from these losses, in the sense that we're seeing more stabilization. In other words, growth has returned to fairly flat rates as opposed to negative. And in some cases, in some months in 2024, we've actually seen positive growth in housing sales for the first time in about 2 years. And this accompanies the fact that if we look at total sales volume, the actual number of sales, that has returned to levels that are approximately where they were in 2019 and early 2020 before the pandemic began. So really getting back to more normal levels of activity, and this correction or readjustment is largely behind us. So a significant readjustment, to be sure, but the bulk of that readjustment likely behind us as we move forward. And I'll just show you one picture here of the manufacturing industry, just to illustrate that this is a goods market phenomenon more generally, a durable goods bubble. Again, you see a very similar picture here. The ISM Purchasing Managers Index that we're looking at reflects the overall, is one measure of overall manufacturing activity in the United States. Anything over 50 represents expansion. Anything below 50 represents contraction. And again, I don't want to spend too much time talking about manufacturing, but I do want to illustrate to you that manufacturing has gone through a very similar readjustment phase as well because of these rising interest rates. The correlation or the tie to that first interest rate hike isn't quite as direct as it is for housing, because housing goods are typically more expensive than manufactured goods for the average household. But nevertheless, we see that readjustment taking place through 2023 and into 2024 as well. Now, one other important component of what's going on with housing right now, in addition to sales activity in terms of the pullback following the rise in interest rates, is what's going on with prices. And prices have, for the first time in recent history, begun to decouple in terms of their trends when comparing them to what's been going on with sales data. In other words, historically, we tend to see sales and price changes move in the same direction, as you saw here before 2020. So when demand rises, when sales go up, that leads to an increase in the median price. So sales activity and prices tend to go together. They move in a positive direction together, and they tend to move in a negative direction together. But that trend, those trends where they move together, that changed significantly, again, following the pandemic and especially following this first interest rate hike in 2022. Again, very clear, right? These are not subtle changes in the market. You can see two different directions in terms of where median prices have gone in South Carolina compared to overall housing sales, which are down about 2.3% overall compared to 2017, as opposed to prices being up about 75%. And what's happening here, the key in explaining this difference is inventory. It really comes down to supply, comes down to existing inventory. What we have seen in South Carolina and to a large extent across the US is a decade-long period of underbuilding that started in the aftermath of the Great Recession in 2008. Many builders went bankrupt. Others were very skittish about getting back into the market because of low demand during 2009 and 2010. And others faced significant new regulations that they had to deal with. So for a variety of reasons, we saw a significant decline in building activity in the aftermath of the Great Recession, and that persisted all the way through present day. And at the same time, South Carolina was continuing to see steady rates of population growth. So demand was continuing to rise. More people were moving to the region, to South Carolina, but we weren't building enough homes to satisfy that demand. So that generated a lack of inventory. Now, fast forward to 2022, and we have a second factor that is contributing to this lack of inventory, namely these rising interest rates. And what has happened is that in an environment where rates have gone up fairly quickly, we now have an increased number of existing homeowners who are locked into lower rates, perhaps as low as 3%, and they are now looking at mortgage interest rates that are available today, which in some cases are twice as high or perhaps even more so. So that makes existing homeowners far less likely to want to put their house on the market if buying is an option from them. If they're thinking about it, but it's not mandatory, they're far less likely to want to sell because they would see such an increase in that mortgage interest rate. And so that's created a second deterrent and limited existing inventory. And in fact, here's a graph that comes right out of the report that was released yesterday, looking at mortgage interest rates. This is figure 6 for reference. And you can clearly see this difference between the current 30-year mortgage interest rate in dark blue, which is around 7% right now, and what the average mortgage is for existing homeowners. Right. So again, on average, and of course, everyone's mileage varies. Everyone is a bit different. But on average, we see that for existing homeowners with a mortgage, the average mortgage interest rate for those households is about 4.1%. So if that's what they're facing today, and then they look and say, well, if I want to move, I'm going to have to get close to a 7% mortgage interest rate. Again, not so attractive. And that difference is as high as it has been in over a decade. And that makes a difference when looking at inventory. And so what does that mean? It means from a pricing perspective that there's still going to be upward pressure on prices because of supply constraints. This lack of supply is having a greater impact on the market than the pullback in demand. When supply goes down, prices go up. When demand goes down, prices go down. So the supply effect is just having a bigger impact than the demand effect, simply because of this lack of inventory that has really persisted and has been emerging over the last decade. And the last way that we can see this is if we look at actual construction activity, which also shows this supply challenge that we're facing in South Carolina. So this looks at it from an employment perspective. But if we look at construction growth, you can see that there was a bit of a pullback in 2022 after rates started rising. but but construction growth never went negative. It's still been very positive. It's begun to recover in 2023 and 2024, which is unusual given the fact that, again, demand for the most part, going back to the sales growth that we looked at, has been negative since 2022, up until up until the last several months or so. So how can that be the case? How is it possible that we're still seeing strong rates of construction growth even as demand is retracted? The answer is, once again, goes back to that lack of inventory. Supply has been so low that there's still a need for new housing units, despite the fact that demand has pulled back. So when we look at this change in demand and sales activity and look at the change in prices, that difference has emerged, and it largely goes back to these supply changes and this lack of inventory. That's what explains that change. And so we're likely, because of that lack of inventory, likely to continue to see prices going up, not at as strong of a rate as we saw before 2022. So again, housing prices have tapered somewhat, but they're still moving in an upward direction compared to overall sales. Okay, so with that in mind, then let's transition and talk a little bit more about the future for the remainder of our time this afternoon. We've talked about the great readjustment that we are going through. We've talked about a resilient economy that has persisted into 2024, but a readjustment that is occurring especially in the goods market, which has affected housing and has affected manufacturing as well. We've talked about the loss of purchasing power that most consumers have experienced, and how the loss of purchasing power and rising interest rates have had implications for the goods market and especially for housing. So what does that tell us about the second half of the year as we move forward and as we begin to look ahead to 2025? Well, there are two things that I think we need to emphasize, and two things that I want to mention with respect to where we are headed next. One is a piece of good news, and that's that the likelihood of recession has dropped significantly this year, and especially since January, and certainly since last summer, over the last year. The recession likelihood has continually dropped. We'll talk about why that's the case, but that's very good news as we move forward. So we're more likely to see positive growth in the second half of the year. But the bad news is that inflation is still too high. Even though it's dropped to 3%, it's still too high, and its downward momentum has also slowed. And some think it's really stalled out. And that has implications for interest rates going forward. Because if inflation is not continuing to tick downwards, that makes it less likely that the Fed is going to lower interest rates in the second half of the year. So it's incredibly important to get a handle on what inflation looks like and the factors that may or may not continue to drive it towards the Federal Reserve's target of 2% in the second half of the year. So good news that a recession is less likely. The bad news is that inflation's downward momentum has slowed a bit. So let's talk about each one of these in a bit more detail. So first, the recession likelihood has dropped. Why is that the case? Why can we be more confident that we won't see a recession this year? Well, there are two parts to this story. Number one is looking at this comparison between inflation and wage growth. And this we already looked at earlier in a different form. But remember that we talked about the fact that even though purchasing power has been lost in the last 3 years, in the last 12 months, we've actually seen wages that have outpaced inflation. Remember, 3.9% versus 3.0%. And that's what you can see here. Basically, in May of 2023, we reached an inflection point where, for the first time in more than 2 years, wages have been growing faster, consistently have been growing faster than prices, which means that consumers are beginning to claw back some of that lost purchasing power. Again, we already talked about how so far that's not enough to offset all of these losses that we saw basically between April of 2021 and May of 2023, but it is a start. And what that means is that since we've, in a manner of speaking, stopped the bleeding when it comes to this loss of purchasing power, that is good news going forward. But it's even better news when we look at the current levels of consumer spending growth. And what do we see here? When we zoom in and just look at what consumer spending activity has looked like over the last 2 years, you can see that it's been very stable and steady and comparable to pre-pandemic norms. So this horizontal line here represents 2.5% growth, which is the average annual growth rate of consumer spending before the pandemic. And you can see that what we've experienced over the last 2 years, again, very comparable to that. So what does this have to do with a future recession? Well, what this tells us is that given that consumer spending has been very stable and steady, and you couple that with the fact that consumers are no longer losing purchasing power, it implies that we are likely to continue to see this type of trend throughout the rest of 2024. Since consumers are no longer losing purchasing power, it is more likely that they can maintain the levels of consumer spending that we have been seeing over the last 2 years. And that makes us far more confident that we avoid recession going forward, at least in the second half of 2024. So this is good news for the second half of the year. A second element that makes us more optimistic that we avoid recession, aside from consumer spending that is more likely to persist at current rates, is the fact that the labor market remains very strong. So let me just share with you a couple of indicators that illustrate this. One way to see this is to look at the ratio of the number of jobs per unemployed person. So this is just a simple ratio that we can look at, which is currently at 1.2, meaning that at the US level, there are 1.2 jobs available per unemployed person. In South Carolina, that number is actually a bit higher. It's closer to 2 to 1. And we actually have more of a labor shortage in South Carolina than we do elsewhere in the US. But for the purposes of our discussion surrounding the strength of the labor market, the conclusion is the same, that the labor market still remains very strong. And in fact, by this metric, we are just now beginning to approach pre-pandemic norms with respect to this metric of jobs per unemployed person. Notice also that this ratio has been slowly ticking downwards since March of 2022, which again is when the Federal Reserve began to increase interest rates. Their goal in increasing interest rates was to lower demand and help pull inflation down. And they have been successful in that so far. We've actually seen a we've seen a slow pullback in economic activity that has also shown the labor market to begin to taper as well. Again, still a very strong labor market overall, but not quite as strong as it was back in 2022, as measured by this metric in terms of the jobs per unemployed person. We see a very similar story if we look more closely here in South Carolina. If we look at employment growth going back to 2021, same story, right? We see positive employment growth, so still a strong labor market, but growth has not quite been as strong as it was before the Fed started raising rates in 2022. So a clear change, right, in employment growth in the 2-year period between 2021 and 22 versus 2023 and in 24. So a tapering labor market, one that's still healthy, but we're not adding quite as many jobs as we were before the Fed began to raise interest rates. Again, consistent with this idea of a soft landing, with the idea that the Fed wants to get inflation down to their target by pulling demand down, by getting demand to come down at the national level. But they do not want to put us into a recession. They don't want demand to pull back so much that we start seeing layoff activity or negative employment growth. And again, both metrics here are consistent with that story. And then finally, one other measure of the labor market we can look at is taking a look at initial unemployment insurance claims data. And this, I would suggest to you, is the best single measure or leading indicator, I should say, for the local labor market that we have. And this represents the number of newly laid off employees in South Carolina. So anytime someone in South Carolina is laid off from their job, they have the option to file an unemployment insurance claim and to file for unemployment insurance benefits with the Department of Employment and Workforce. And when they do that the first time, they're considered an initial unemployment insurance claimant. So we can tally up the number of initial claimants and track that over time. And that gives us information on the number of newly unemployed people. So it really gives us a good sense of whether or not there are a lot of employers who are laying off a significant number of workers throughout South Carolina. And what you can see here is that if we track this over the last several years, really no evidence at all of any significant uptick in unemployment or in layoff activity in South Carolina. Overall, unemployment insurance claims very much comparable to where they were before the pandemic began. Again, that black line there represents the weekly average before COVID in 2020. Again, giving us some insight into the state of the labor market, which suggests that it continues to be very healthy overall. So good news as we look forward, in that we are far more confident that we avoid recession in 2024 in the second half of the year. But as I mentioned, it's not all good news. We also have to consider the implications of higher interest rates and how inflation is likely to have an impact on interest rates during the second half of the year and Fed policy. And as I've mentioned before, a good way to really summarize this is if we're trying to get a handle on interest rates and where interest rate policy is going, the key driver, again, all other things aside, it just comes down to what I would call inflation's stickiness. That is the main driver for interest rate policy going forward. So we have to get a handle on where inflation is going and whether it's going to be sticky at around 3% or whether it's going to continue its downward trajectory. So with that in mind, let's actually look at inflation to get a handle on where it's been and what we mean by sticky inflation. So here we can look at the overall inflation rate for the US, which is represented by this blue line here. You can see that inflation peaked at 9.1% back in June of 2022. It dropped to 3% by June of 2023, but it is still 3% currently as of June 2024. It really hasn't moved at all over the last 12 months. It's basically bounced around between about 3 and 3.5%. And the Fed's target, what the Federal Reserve wants to do is they want to get inflation down to 2.0%. They've been crystal clear about that goal. Not 2.9, not 2.8, but 2.0. And so to the extent that inflation hovers around 3% and doesn't continue that downward momentum, that makes it less likely that they will lower rates during the second half of 2024, or at least they won't lower rates by as much as they might have otherwise planned to do. So we want to get a sense of the likelihood that inflation is going to continue to go down. Now, the good news here is that in the last couple of months, we have begun to see some pullback if we look at monthly inflation data. So the overall numbers that we see quoted in the news, those are annualized figures. But if we just look at month over month, that gives us a more real-time measure of how inflation is doing. And so here you can see these orange bars. Inflation's actually been close to zero in the last couple of months. So that may be a positive indication that inflation is showing a pattern of resuming its downward trajectory. We don't know that yet. It will take several more months worth of data to validate, but that is a good start. But again, we've seen that before, right? We've seen low rates of kind of one-offs for low inflation here that really haven't been very consistent. But that is a good start to the summer months. We'll see if that continues or not. However, this is still very much an open question as to whether inflation will go down. And that's because the bulk of the drop in inflation between 2022 and 2023 actually is the result of the pullback in housing costs. So if we just look at the growth in housing costs for the US as a whole and in South Carolina, you can see that while housing costs are still going up, as we talked about before, they're still rising. They are not rising by nearly as much as they were back in, say, 2021 and 2022. So the blue line looking at the overall annual averages, growth about 15% compared to today, where we're at about 5%. And this period where it was moving down, that significant movement downwards, that's where we saw this big decline in inflation from 9.1 to 3.0. So what's happened in the last year? Well, the housing market has stabilized, as we've already talked about. And as a result, prices are also stabilizing more. And we've seen a bit of an increase in the rate of in the rate of price growth. So what does that tell us? Well, from an inflation perspective, what that tells us is that the major factor pulling inflation down is not likely to be pulling inflation down going forward, right? Because we don't expect to see this type of pullback again. We're seeing more stabilization now. So if we're going to see inflation move from 3% to 2%, where the Fed wants it, the source of that pullback in inflation is not likely to be the housing market going forward, which means it's going to have to come from somewhere else. And here's where we are somewhat concerned that there are not that many factors that are going to help pull inflation down. Most factors right now, most macroeconomic factors are actually fighting against the Fed. They're putting upward pressure on prices. We're seeing that in terms of housing prices, which we just talked about, but we're also seeing that because of the ongoing labor shortage that is still with us, that's putting upward pressure on wages. We've seen a significant increase in shipping costs and global shipping costs in 2024 because of terrorist activity going on in and around the Red Sea. We've seen continued high government spending, particularly around a lot of COVID dollars that are still out there, and a lot of geopolitical uncertainty, which is moving the U.S. from a policy perspective away from more free trade agreements and more towards protectionist agreements, for lack of a better term. And all of that is putting upward pressure on prices and is fighting the Fed and making it harder for them to get inflation down to 2%. So the bottom line here is this is very much an open question as to whether inflation sticks at 3% or it continues its movement downwards towards 2%. But that's what the Fed is looking at. That is the key metric to track to see whether interest rates are likely to decline this year or not. So we can summarize that by just looking at the trade-off here that the Fed is tracking to get this soft landing: inflation and unemployment. Inflation versus unemployment. So the Fed's target inflation rate is 2%. We're still a percentage point away from that. And so they're going to want to leave interest rates higher where they are until we get more evidence that inflation is continuing to tick down towards that 2% target. But they also want to avoid a recession if they can. And so they're not going to want unemployment to rise beyond about 5%. That's typically the rule of thumb for a healthy labor market. Anything below 5% is considered very strong. And right now at the US level, unemployment is around 4%. The unemployment rate's about 4.1% currently. So that's what the Fed is looking at. They want inflation to continue to go down. And I would suggest to you that they are more likely to lower interest rates if we continue to see downward movement for inflation towards 2%, or we were to see the unemployment rate tick up significantly, especially if it gets above 5%. Again, currently at right around 4%. So this trade-off is really what they're watching: inflation versus unemployment. That's going to drive the discussions surrounding interest rates and gives us some insight into what to expect. So we really need to watch that inflation rate as we move forward, because this is going to be the primary driving factor, with employment also right behind it. Okay, so wrapping up. For the rest of this year, what are our expectations overall? South Carolina's economy, as we've talked about, remains very stable. The odds of a recession have gone down significantly this year. That's the good news. More stability, less likely that we see a recession for the rest of 2024 and into 2025. More good news is that the readjustment period of the housing market is largely behind us. We've actually seen positive growth in certain months in the spring going into the summer. So that's good news that the bulk of this readjustment period, again, likely behind us. But we do expect that South Carolina will likely see relatively flat sales growth for the remainder of this year. If we were to see any type of uptick in sales this year, it would likely come from some kind of stimulus effect from the Fed lowering rates. So keeping our eye on interest rates and what Fed policy is going to be crucial this year to get some insight as to whether the flat sales growth that we currently expect will turn to be significantly positive. Will the Fed lower rates this year? I would suggest to you that the likelihood is about 50-50, simply because inflation's downward momentum has stalled, as we've already talked about. So we want to continue to keep our eye on these monthly inflation reports. But as of now, I would say that there's about a 50-50 chance that we do see rates coming down in 2024. But as I mentioned, the last bullet point here, any decrease in interest rates would increase the demand for housing, which would create a stimulus effect, more sales activity. But these low inventory levels are going to continue to be with us, certainly for the foreseeable future, and that will keep upward pressure on prices for the foreseeable future as well. So that is our outlook for 2024 and into 2025. And with that, I will stop there and be happy to answer any questions. And Alan, I'm gonna turn it back over to you to facilitate questions.
Thank you, Dr. Joey Van Nessen. That was an excellent report. Some great news that is relayed in there. And one of the first questions I have from multiple attendees is it possible for us to share your slides?
Yes. So I
Okay.
will, just from a logistics standpoint, I will share them, Alan, with you and with the team, and then you all are free to share them. So anyone can either ask me directly, email me, I'll be happy to share them, or email you.
Okay, thank you very much. And so the next question I have is, Citi analysts put out a predictive analysis that they believe that 200 basis decrease to the Fed rate is going to happen in the next 8 months, lowering the Fed rate by July of 2025 to 3.2535. Do you think that's a very optimistic viewpoint, or where do you land on this?
Yes, so that's a great question. I would say right now that's a bit more optimistic. I think that would be more likely if we were to see a recession, that we would see more significant rate cuts. And as I mentioned, right now we are more optimistic that we avoid recession. I think that what we are likely to see, if inflation continues to tick down, then we would begin to see rate cuts by the end of this year. I think it's more likely that we'll see rate cuts in December than in September, because I think the Fed is going to want to see several months worth of data showing that inflation is consistently ticking down to 2%, right? So they want to know that this 3% stickiness is behind us. So they're going to need consistent evidence for several months to give them more confidence there, which I think alludes to perhaps a December rate cut as opposed to a September. I'm not saying that they wouldn't necessarily move in September, but I think it's more likely that we see something later in the year. And that could put us down to a federal funds rate closer to 4% next year. But do we get down to 3% next year? Probably not, because there are still a lot of factors that are fighting the Fed, particularly this labor shortage, which is going to keep upward pressure on wages, and I think keep inflation. It's going to require higher interest rates to keep inflation down as we move forward.
Thank you for that answer. I have another question: is what's your opinion on how the impact of how quick the Fed interest rate rose when they started back in 23 or 22? Sorry.
How quickly does the impact begin to be felt, you mean?
Do you think there was a knee-jerk reaction to the overall economy, or do you believe that it was appropriate measures to maintain balance or to get the inflation down quicker?
Well, I think so. So kind of two questions there. I'd say, was it appropriate in order to get inflation down? I would say yes. I think the Fed has increased rates to a degree that has helped to pull inflation down and has clearly helped to avoid recession. I think certainly there have been certain industries that have faced the ramifications of that more than others, housing being, again, as I mentioned, on the front lines of the battle against inflation. But I think raising interest rates was necessary to get us to this point, to get inflation down to where we have it. So from that perspective, I think we're moving in the right direction, and we will likely see rate cuts within the next several months. We don't know when, but it just depends on how long it takes to see inflation begin to continue to tick downwards. And to your other question, how quickly do interest rates have an effect? It usually takes about 12 to 18 months for any given interest rate hike to have its full effect on the economy. So if we were to see interest rates begin to go down this year, either in September or later in the fall, that's going to have effects throughout 2025, which from the housing market's perspective is actually very good because would point to a better year next year, assuming that we didn't go into a recession before then. But like I said, we're not expecting that at this time.
Okay. And then there's a mixture of questions out there about affordability issues and well, your presentation showing that our wages weren't quite kept up with some of the price increases. So if we did see interest rate cuts, would that also create an adverse effect to pricing of the housing, you think? Or would the pricing stabilize and the housing would become more affordable?
So I think it would certainly help affordability. I don't think there's any question about that. And it would be a general stimulus, or it would stimulate demand. So on net, I think a cut in interest rates is going to help housing demand going forward, and puts us in a better position as we look forward towards 2025. Again, we don't know when that's going to happen, but I think if we look more long term, if we say, well, what do we expect growth to look like between summer of 2024 and summer of 2025? I think at this point, we would expect positive growth in the housing industry overall. It's just how long do we continue to see kind of the flat growth that we've seen so far this year before it begins to generate more positive gains? And again, that comes back to the timing of interest rate cuts. Does it happen in September or does it happen in December? And that's the open question.
Okay. And then this is a great economic question for you. Is it possible that core prices could fall negative? And if so, is that a good thing or a bad thing?
So I'd say the short answer is that would be a bad thing. If by core prices, you mean if we see the overall prices in the economy begin or actually go down, that is not something that we want to see. And that's called deflation, which is different than a reduction in inflation. So when inflation comes down, what that means is that we're continuing to see prices rise, but they're not rising by as much as they were before. So ideally, we want to see prices going up at about 2% per year. That's the Fed target, and that's consistent with a healthy economy, an expanding economy where we're seeing growing demand. That's always going to put upward pressure on prices. The only time you see a decrease in the overall price level is when we experience a recession. And so typically that's not something that we want to see. So that means that we have to look to wage growth to help to offset these losses in purchasing power. And that just takes time. But we are not likely to see prices go down again in the aggregate. But that's not something that we want to see. Again, that's usually only follows a recession.
Okay. Thank you. I have another question for you. Might we see a closing of the gap of the 30-year mortgage and 10-year treasury, even without a rate cut?
I think it's certainly possible. But I think it is. I think we are going to see rate cuts going forward. It's just a question of timing. So I think we have to factor that in terms of what that looks like. So that depends on when we begin to see rate cuts. Again, is it September or is it December or possibly into 2025? I don't think it would be that long. But the other factor when we look at interest rates is that I think we have to recognize that interest rates are likely to be higher going forward than they were in the previous decade. So yes, interest rates are likely to go down, but they are not likely to settle close to where we were before the pandemic. And the reason is that there are a number of factors that are driving inflation up that we talked about before. The two most important being the fact that we still are seeing a labor shortage, which is likely to persist for the foreseeable future, because a lot of that's structural, because baby boomers have left the labor market, they've retired. So that puts upward pressure on wages. And then secondly, we're seeing more and more of more activist is at least one word for it, but activist industrial policy. And that's true across the political spectrum. I like to say that tariffs now, tariff is a six-letter word, right? It's literally a six-letter word. But I like to say, well, 15 years ago, it was a four-letter word, right? So I say that as a joke, but in all seriousness, we've moved away from open trade and globalization, and we are much more in a position where we're wary of geopolitical relationships now. And so when we restrict globalization and open trade, that also puts upward pressure on prices. So for a variety of reasons, we are likely to need higher interest rates going forward to keep inflation down.
Okay. I think we are at the end of the hour. Do you have time for one more question, or do
Yeah,
you need to wrap
absolutely.
up? Okay. So this one is, what do you expect the South Carolina commercial market to be for the remainder of 2024? You think it's going to follow the same trend lines as kind of the housing, or is it, it is a different sector, but where do you feel like the commercial sector is going to land?
Yeah, that's a great question. I think there are at least three components of the commercial real estate market that we have to look at independently. If we look at commercial office space, it's still very much in a readjustment phase because we really haven't landed on a permanent new professional norm yet with respect to remote work versus going back to the office. And a lot of businesses are still trying to feel that out in terms of what commitments they want to make. So commercial office space still very much in flux. Multifamily housing has continued to do fairly well because we've seen rising, particularly in the Southeast, because we've continued to see rising demand as we've seen more people moving into this area. And then retail space in general has done fairly well. As consumer spending has remained fairly strong, and we've seen a resilient economy. So those at a high level are what we're seeing right now, but certainly commercial office space is the biggest unknown right now because they're still going through a readjustment process.
Okay. Well, I appreciate your time today. And just to let everyone know, what we'll end up doing is we'll get the slide deck, and we have your emails from the registration, and we'll send that out. That's how you will receive it. So I'm trying to read a couple of these last ones before completely signing off.
And I'll just make a final comment that I think is important for everyone to recognize, and that's that even though the second half of this year, we're likely to see, again, more weaker growth or either flat or slightly positive growth, the long run outlook for housing in South Carolina is extraordinarily strong. And that comes down to migration patterns. More people are moving to this area. We're going to see more than 6 million people in South Carolina by the year 2042, or the current projections. That's a growth of about 1 million new residents. And they're all going to need places to live. So even though, again, the next few months are a bit rocky, we've seen some readjustments that have been happening that everybody's been affected by. But the long-run outlook for housing in South Carolina, very, very strong. And so I think that's important to keep in mind at the end of the day.
All right. Well, I appreciate your time as always, and we look forward to your year-end summary. And we'll do this again in 6 months, give or take. And thank you all South Carolina members for joining us today. And hopefully this has been impactful for you as it is for me. And we always love having you provide us with some new knowledge and economic understanding of what's happening out there.
Well, thank you, Alan. My
so
pleasure,
much.
and good to see everyone.
Y'all have a good day.